Hey everyone, and welcome to this explainer. I am absolutely thrilled to have you here with us today because we're taking a really deep dive into Learning Module 2, Portfolio Risk and Return Part 2, which gets into the absolute core mechanics of modern portfolio theory. We're going to unpack exactly how financial markets price risk and how you can use these frameworks to genuinely understand the relationship between the risks you're taking and the returns you should actually be expecting.
Okay, let's dive into this fundamental challenge. Think about it for a second. Every single day, investors make decisions to put their hard-earned capital on the line. But how do we actually know if an investment's return is worth the risk? Like, if I decide to take on a higher level of volatility, how much extra return should I mathematically demand to make it a fair deal? Well, answering that question is pretty much the holy grail of finance.
To solve this, we'll be using a building blocks approach today. First up is the capital market line, then systematic versus non-systematic risks, followed by pricing risk with CAPM, the security market line, and finally evaluating real-world portfolio performance. All right, starting with block number 1, the capital market line. So, to build the ultimate, optimal foundation for an investment portfolio, capital market theory establishes two absolute extremes. Think of these as the fundamental ground rules of our financial universe. On one side, we have the risk-free asset. Think of U.S. Treasury bills. They have zero default risk, zero inflation risk, zero liquidity risk. You know exactly what you're going to get. Period. On the completely opposite extreme, we have the market portfolio. Theoretically, this includes every single risky asset in the world. But for practical purposes, we generally use a proxy like the S&P 500 index to represent that optimal bundle of risky assets. Now, when you take those two extremes, the risk-free asset and the optimal risky market portfolio, and you start combining them in different proportions, you create a literal line of opportunity. And we call this the capital market line, or CML. It represents every single optimal combination of risk and return that is actually available to an investor. I want you to kind of imagine the spatial positioning here. If you look at a graph of this line, the y-intercept, where risk is perfectly zero, is exactly your risk-free return. Now, according to capital market theory, any point floating above this line is mathematically unachievable. No way to get there. And any point below the line, well, that's just inferior, because it means you're taking on risk without getting the proper reward. Your ultimate goal is to be perfectly on the line. But what if you want returns that are actually higher than the overall market? Well, moving up the line past that market portfolio simply means you are borrowing money at the risk-free rate to leverage your investment into the market. So you get a higher expected return for sure, but with significantly higher risk. Moving right along to section 2, systematic versus non-systematic risk. We have to ask ourselves, is all risk created equal? If you take on more risk, does the market automatically owe you a higher return? The answer to that is a definitive no, and here is exactly why. We have to divide risk into two entirely distinct camps. First, there's systematic risk. This is market-wide, unavoidable, and totally non-diversifiable. Think about big macroeconomic factors: inflation, shifting interest rates, broad economic cycles. You literally cannot escape these by simply buying more stocks. Then, on the other hand, we have non-systematic risk. This is company-specific, highly local, and entirely diversifiable. A great example from our source material is the failure of a specific pharmaceutical drug trial, or maybe an airline crash. Obviously, it's totally devastating for that specific company, but it doesn't really affect the broader market. So the crucial point is this brilliant concept of the free lunch in finance. Wall Street is famous for not handing out free lunches, and this rule is absolutely no exception. If you hold a single stock, you're bearing a lot of non-systematic, company-specific risk. But because you could easily eliminate that exact risk by just diversifying your portfolio, the market doesn't pay you for it. You simply do not get rewarded for holding on to risks that you could easily diversify away. You are only ever compensated for systematic risk. Which brings us to section 3, pricing risk with CAPM, or the capital asset pricing model. Since we now know for sure that only systematic risk gets rewarded, how do we actually measure it? We need a metric, and that missing key is called beta. Beta measures exactly how sensitive a security is to overall market movements. The broader market naturally has a beta of exactly 1. So if an asset has a beta greater than 1, it's more volatile than the market, which means it absolutely demands a higher expected return. If it's less than 1, it's less volatile and naturally demands a lower expected return. Let's see how this all elegantly comes together in the capital asset pricing model, or CAPM.
Just looking at the math here, CAPM states that the expected return of an asset equals the risk-free rate plus its beta multiplied by the market risk premium. And that premium is just the expected return of the market minus the risk-free rate. So in this example, with a risk-free rate of 4%, a total market return of 16%, and an asset with a beta of 2.0, the formula calculates a required return of 28% for that specific stock. It's amazing. It perfectly connects the risk-free rate, the asset-specific systematic risk, and the premium the overall market happens to be offering.
Let's map this out in Section 4, the security market line. And this brilliantly illustrates what happens if we take the elegant math of the CAPM and turn it into a powerful visual tool. Welcome to the security market line, or SML. This graph literally plots CAPM for us. You've got beta, our measure of systematic risk, running along the horizontal x-axis and expected return on the vertical y-axis. The line starts right at the risk-free rate on the y-intercept and passes exactly through the market portfolio where beta equals 1. Because of this, any individual security's expected return can be mapped directly onto this line based purely on its beta.
Now, it is incredibly critical that we don't confuse our two lines. The capital market line, our first building block, uses total risk on its x-axis, and because of that, it only applies to perfectly efficient, well-diversified portfolios. The security market line, however, uses only systematic risk, beta, on its x-axis, and because of that distinction, the SML applies to literally everything, individual stocks, wildly inefficient portfolios, you name it. Total risk and systematic risk are only equal to each other when a portfolio is completely, perfectly diversified.
Finally, Section 5, evaluating portfolio performance. This brings us to the real climax of our explainer. We've built this amazing theoretical foundation, but how do we actually use these tools to evaluate real-world investment managers? Like, are they actually earning those hefty fees? To judge that, we have our ultimate scorecard. We use 4 key appraisal measures: the Sharpe ratio, the Treynor ratio, M2, which stands for Magliani-Magliani, and Jensen's alpha. These 4 metrics will tell us straight up if a manager's return is genuinely a result of their skill, or if they just took on way too much uncompensated risk. Think of this as your cheat sheet on when to use which tool. The Sharpe ratio and M2 evaluate performance based on total risk. You're going to use these if you are evaluating an investor's entire, potentially undiversified portfolio. And M2 is actually really great because it translates the Sharpe ratio into this super easy-to-read percentage return advantage compared to the broader market. On the flip side, the Treynor ratio and Jensen's alpha evaluate performance based purely on systematic risk, or beta. Use these when evaluating a manager who represents just one piece of an already well-diversified portfolio. All right, let's put on our consultant hats and look at a high-stakes, real-world scenario right from the source material. We have a British pension fund evaluating 3 different managers, X, Y, and Z. The overall market is returning 9%, and the risk-free rate sits at 3%. Now, if you just look at the raw average returns, manager Z seems to be absolutely crushing it, with a 12% return. But we know better than to just look at raw returns, right? We have to adjust for risk.
Now, what's really interesting about this slide is the total plot twist it reveals when we plot these managers against the security market line. All 3 managers are technically above the SML, meaning they all successfully beat the benchmark. But who is actually the best? Well, if the pension fund was going to give literally all its money to just one manager, making it their total undiversified portfolio, manager Y actually wins. They have the highest Sharpe ratio and M2. But if the pension fund remains broadly well-diversified overall, and they only care about that systematic beta risk, then manager Z takes the crown with the highest Treynor ratio and Jensen's alpha. So the right answer entirely depends on which specific type of risk you are actually evaluating. To drill down just a bit more on Jensen's alpha, take a look at the security characteristic line. When we plot a security's excess return directly against the market's excess return, we get this regression line. The slope of that line, that's your beta. But the vertical intercept, literally where the line crosses the y-axis, that is Jensen's alpha. If it's a positive number, it is the literal mathematical representation of superior investment ability. It means they are generating return above and beyond the risk they've taken. Which brings us to our final thought. The models we explored today aren't just dry academic exercises. They are the literal rulebook for how capital is priced in the real world. So I leave you with this. Take a hard look at your own portfolio. Are your investments actually rewarding you for the systematic risks you take? Or are you just holding on to diversifiable risk, giving the market a free lunch completely at your expense? Thank you so much for joining me on this explainer, and keep questioning the mechanics behind your returns.